Is Australia's housing market going to collapse in 2023? Let's find out. To understand why the market might collapse, we need to look at what has happened in recent years. The COVID-19 lockdowns caused governments around the world to take unprecedented steps to stop the world shifting into what could have been a depression. Most advanced economies undertook this with a combination of both fiscal and monetary stimulus, which is the government spending more and the central bank reducing interest rates. At the same time, the Reserve Bank of Australia reduced interest rates to 0.1%. This led to home loans below 2%, the perfect dream for every mortgage holder. As a result of all this additional stimulus, the housing market boomed in 2021, with the median house price in Sydney growing from $947,000 in March 2020 to $1,340,000 by December of 2021. Since the GFC in 2008, interest rates have been on a one-way direction, and many individuals and lenders operated on the theory that money will always be cheap. That theory has quickly been disproven, with the cash rate rising from 0.1% to 3.1% from April to December 2022, putting the cash rate at levels not seen since 2012. In 2012, this was an expansionary monetary policy stance taken by the central bank, vastly different to the contractionary policy that is currently in place. The table is a brief overview of property prices versus weekly earnings between 2012 and 2022. As you can see, the median property price in Sydney in 2012 was $640,000. By 2022, it was $1.2 million, an 87.5% change. Compare this to the average male weekly earnings, which has only grown 24.4% in this time frame, and the average female weekly earnings, which have only grown 31.7% in this time period. It is evident in the dataset that property prices have outpaced wages growth by a significant amount. This growth has occurred in an expansionary monetary policy setting by the central bank. This in turn allowed house prices to rise in value because the cost of servicing the debt remained the same or got cheaper even as the values increased. If property prices had a one-to-one correlation to income growth, they would have grown around 24 to 31% over the same period, not 87.5%. 10 years on, the monetary policy setting has reversed from expansionary to contractionary. Already, the median price of properties in Sydney has fallen from its high in December 2022 of $1.34 million to $1.2 million, down 10.45%. It's clear there is a disparity between income growth and property price growth that has occurred over the last decade. Whilst this disparity was less so an issue under a falling interest rate environment, it's becoming an ever-pressing issue as rates continue to rise and household budgets are squeezed to the max. Should everyone be concerned about the current state of the housing market? Well, housing is the largest store of wealth in Australia. With falling asset prices that is currently occurring at a record pace, Australians' wealth is eroding each and every month. With $140,000 already coming out of the median price in Sydney, people should be concerned about what is to come for three key reasons. Number one, the lag time effect. 2, the falling price effect. And 3, liquidity. As of the time that this is being recorded, which is January of 2023, we only have the September housing quarter figure, so the Q3 figure for house prices. We're yet to find out the Q4 figure that's going to encompass the October, November and December rate rises and the impact that they have had so far on the housing market. Until we get this figure, we won't know exactly how much property prices have fallen during 2022. Unlike other markets that operate with real-time changes in prices and data, real estate operates on a much longer time frame for price changes to show up. For starters, if a house was purchased today, it's going to take a couple of months for that exchange to actually take place. Let's say you settled on a property on the 1st of January 2023. The agreement to purchase that property probably occurred somewhere around November to mid-November. The data for the sale isn't going to be included in the ABS release until Q1 data is released in June, which is 7 months approximately after the agreement occurred. With the extended lag time, it makes it almost impossible, especially with a rising rate environment, to analyze the month-to-month impact of interest rate rises on property prices. The falling price spiral is also something that will have a longer-term impact on prices. It is said that in an inflationary environment, consumers will choose to purchase today knowing that the price will be more expensive next month. With the record property price growth that occurred in 2021, this was referred to as FOMO. However, the reverse is true when prices start to fall. Consumers delay their purchase with the anticipation that the following month prices will be cheaper and cheaper. If this becomes the mindset of consumers, this leads to less demand, and the natural forces of supply and demand then take over, leading to lower prices again. This is an economic spiral that occurs. One of the forefathers of modern economics, John Maynard Keynes, the founder of the Keynesian school of economic thought, argued that during a recession or economic downturn, you wanted prices to be sticky down, or in other words, prices less reactive to economic downturns. The fundamental reasons behind Keynes's viewpoint on prices being sticky down was the moment you have prices falling and falling is it's very difficult to stop them falling because demand evaporates from the market. Most property transactions require some sort of financing to occur. If real estate prices are a reflection of the ability to finance a property, a situation that makes financing more difficult will also have an impact on prices then. This scenario is often termed liquidity, which is the ability to finance. Let's work on the information that we currently have. We know that prices are falling. They're in a downward trend. Since 2012, when the cash rate was at the same level, prices have grown 87% in comparison to incomes, which have only grown between 24 and 31%. If the ability to be financed on a property is a reflection of an individual's income and how much the repayment is going to be on that price, the disparity between income growth and property price growth since 2012 is going to be a real issue for getting properties financed in 2023. Now that doesn't mean liquidity is going to vanish from the system. The government could change the rules around financing requirements to increase liquidity in the market. But without changes to the ability to finance properties, it's actually going to cause a lot of issues around prices. Now let's work on a hypothetical scenario. Let's say you're looking to purchase a property that's valued at around $500,000 and you could get a mortgage for $450,000 beforehand and you had a 10% deposit. Let's say the lender is now only willing to give you a mortgage for $350,000 because of the changes to interest rates. If property prices have fallen by roughly 11%, let's say that property is now worth $445,000. If that 10% deposit was all you had for that property, that brings you with the ability to purchase a property for only $400,000. That's a $45,000 difference between where prices are and where consumers have the ability to finance. Now this is just a hypothetical scenario, but it's to illustrate the point about liquidity drying up and it becoming more difficult to finance properties. In a scenario like what has been demonstrated, there are a couple of outcomes. Either prices continue to fall to match where buyers are. Buyers have to find additional funds to meet the seller at their price. They meet somewhere in between, or the properties don't sell. The raising of interest rates has led the economy and the property market into a very dangerous situation. All we know for certain is that 2023 is going to be a rocky ride in the property market.